Welcome, everyone. Welcome to the Social Impact Revolution podcast. My name is Harold Graham, CEO of Social Impact Investment. We're a platform that marries blockchain technology to ESG reporting. Today, our guest is going to be Karl Weinmayer. I hope I said that right. PhD, and he is from University in Vienna, Austria. And we're going to be having a discussion today on ESG and a lot of different topics within that group. Karl, can you talk to us a little bit about your background and what led you to this topic in your life?
Right. Yeah. Thank you, Harold. Thanks for having me on the podcast. First of all, so I'm assistant professor of finance at the Modul University Vienna, and my whole sustainable finance journey started roughly like 9 years ago when I just had started my PhD, and by coincidence, actually, I was participating in an event that was hosted by Modul University. And there, it was about sustainable finance, but more back then, it was mostly what they called impact investing. That was the dominant phrasing at the time.
I think the acronyms have changed at least 5 times in the last 5 years.
It is quite difficult to set them apart unless you spend a lot of time with them, actually. But so yeah, that was my first point of contact with the topic, and I immediately became fascinated with it. I wanted to know what drives such investors. How can we use such sustainability criteria to create value? Does this actually create value at the firm level, or is it more of an detour for a company? You know, there's have the stakeholder versus shareholder principle topic. And then I started working on it. I managed to do some research with it. Back then, the ESG was a very fresh topic. For my purposes, we need normally quite a lot of data, and back then there was not much available, right? So you only had some very few agencies that provided ESG data.
Even now, there's not.
Yeah, even now, there's still, but actually, they have probably about tripled actually since then the number of rating agencies. So, so that was my starting point with the topic, and even after I finished my PhD, I'm still working on it, and then my university has quite a strong sustainability focus in all its departments. So I'm happy that I can also still pursue this passion with sustainable finance there.
Well, I'm really grateful that you joined us today. This topic is definitely near and dear to my heart. As a former fundraiser for startups and for philanthropy, I got into this because I found that more of the younger folks that were taking over the finances for their families in their family offices, the more wealthy folks who, they drive investment here in the U.S. They were more interested. These groups were more interested in doing good with their funds than they were in pure profit. And as I saw that movement, it really, it moved me to want to be a part of it. Obviously, I'd like to see the world be a better place. And if I can help to steer funding or even direct larger funds to invest in these areas and help companies that are doing the right thing as opposed to just making pure profit or, the highest dividends, I wanted to do that. So let's get started in ESG. And I guess we should start off in your area of expertise, which is sustainable finance. So can you talk to us a little about what that means to you and how you see it in the marketplace now? And then we can talk about where you think it's going for the future.
Right. So sustainable finance is, like, for me, the umbrella term for many things. You have social responsible investing, you have impact investing, now you have deep impact. This is more a recent phenomenon. And what it means for me is that we try to understand why social responsibility, which we measure by using ESG rating agencies, is important. We have, as you said, there are many individuals over the last decade who start to become interested in this topic, not only doing well, but also doing good. That is the overall premise here. And we can also see that many either government funds or also the small private holdings, they have actually now in their regulations, they have like a purpose clause in there which tells them that they should actually commit a certain fraction of funds towards sustainable investments, right? So we can see the assets under management are going through the roof on these topics. The problem is here that it is sometimes very difficult to define what is a socially responsible investment. We have many different SRI funds available, and the increasing number of ESG rating agencies makes it even more difficult to understand, is SRI Fund A exactly the same as SRI Fund B if they have the same rating, right? But if it's coming from a different agency, then you have problems understanding that. So there's something that would call ESG disagreement among these rating agencies. And we can see that there are studies that show that investors actually don't like this ESG disagreement because it's confusing them, right? So I think one thing that needs to happen in the ESG space is that we try to find a common framework. How do we measure these three dimensions: environment, social, and governance? I know the some of the ESG rating providers very well. You can go down up to 400 individual criteria that make up that overall ESG score.
It's a lot of buckets.
It's really important, and it's a very time consuming, and there are lots of analysts sitting there, and each of these rating agencies has a framework behind it, but they are not aligned in some ways, right? So but what I've experienced in my own work is that you can actually create portfolio strategies which might not be the best or in possible, but you can beat other, let's say, indices, passively managed funds, by more directly incorporating ESG criteria into this investment decision process.
Interesting.
And that, I think, is something that makes it very approachable, not only for outspoken philanthropists, impact investors, but also for normal people who want to put some money aside and also not having to worry about the impact that their money generates.
Yeah. Here, a great deal of investors are beginning to attempt to control their own. I say attempt because most of them aren't very good at it, but they're attempting to control their retirement funds. And so instead of allowing a larger company like a Fidelity to handle their retirement funds, they're attempting to take some of that money out and invest it themselves. And so these are the folks you're talking about in regards to, mom and pop who might be putting money into the marketplace, and they'd like to understand better, what their money is doing. Where do you see sustainable finance going? Let's say a 5-year, 10-year benchmark. What are you seeing the market moving to?
Well, I believe that right now we are. I mean, I can speak more from the perspective of the European Union. Right now, we're in a very different place compared to the US. We do have the Sustainable Finance Disclosure Regulation that just was released, that hit the market, and there are also some other regulations that are applicable to banks, which basically demand banks that they actually assess the preferences of their customers with respect to sustainability. And then on the back end, in the back office, you create the products that match these preferences. So there's a lot of stuff happening, and this is really great. And I believe that ESG will play a big role in there, because it makes these preferences in some way, you could say, mappable. You can say, okay, many ways we have, like,
you have to have factors in order to benchmark, right?
Exactly. Yeah, we have some, like, maybe a threshold that is a lower score, which we hopefully agree on, that underlie that. Below that score, it's not sustainable anymore. That's what happens right now. But I believe that over the long run, we will have to go a little away from these screening approaches, where we only say, okay, we exclude some industries or some individual companies, because there's always something missing that is not 100% in line with maybe
we were talking about this a little bit in our initial conversation before we started recording, where there are fossil fuel companies that do belong in an ESG fund, because they are doing everything they can to try to be responsible about how they're extracting and how they're distributing the fuel to the marketplace.
Right. Yeah. So, I mean, it all boils down to personal preferences. One investor might say, no, he wants to definitely exclude such companies. The other investor might just want to provide also maybe a signaling, that we have fossil fuel companies. They are good ones, they are bad ones. We do have them for some time longer. Hopefully, eventually, we will not need them anymore at all. But while they are here, we should send a signal that it can also become beneficial to be more sustainable.
Sure.
So I think
So
that is one thing.
now go to the 10-year mark. I mean, that's a long way out.
Right. Yeah.
I think the movement is only about 10 years old right now. I mean, per se. I mean, yes, people were talking a little about socially responsible investing, and I mean, there are some folks in the industry, in the investment industry, who have actually been involved in social impact since the 70s, but they were far and few between. And so, like, there were hedge funds in the 70s too, but only a few wealthy people had paid their managers to do the investments in that manner. Around the mid 90s, hedge funds became the norm, and by the 2000s, they had reached their peak where, the 2 and 20 model was a well-known term and everybody understood it. And now they're on their way out. So where we are on the basketball through the garden hose, if I'm going to use a marketing term, I think we're at the very beginning stages. But in 10 years from now, we'll probably be closer to the peak. I'm wondering what you think the peak looks like.
Well, yeah, I totally agree. This topic, even though it's now 10 years old, it's still completely fresh. I mean, we just start to understand what the social responsibilities. Yes. We start to take companies and funds and banks into the responsibility of taking care of these things. So I believe there's still a lot to do before these systems and these processes are actually up and running, and that can take years because banks normally take quite some time until they fully adopt the regulation. They have a lot of
almost as slow as the government, right?
Almost, yeah. They have a lot of things to consider when looking at these, because they have already a lot of existing regulation which they have to bring in line with all these changes that they have to make to their processes and to their products, actually. So I think that it will take a couple more years until we actually are at the peak of this ESG movement. And then hopefully we will also be able to bring more people into the actual impact investing part, where we don't have to only look at public equities anymore for sustainable investments, which we measure with ESG criteria, but where we can also look into private equity, because that's where many people say the real work happens, right? Yes. So we have small scale private equities that are in this space that do really amazing work, which are sometimes even only project based, and it's impossible for the normal person to get into these things, because one, you don't know about it, and second, you wouldn't be able to participate because the private equity investments are very risky, right? You don't have your money at your disposal. So you lose potentially a lot of liquidity in your household finances. So this is something where I would like to see the movement going, that makes it available also for people to really go into the impact investing side of sustainable finance in the future.
Okay, so and that actually wraps in nicely with how I see the market moving, which is, I feel like the majority of consumer product companies are going to begin to report on ESG factoring, even on their products. So I had a number of guests in our earlier podcasts, and some of their ideas were, one gentleman said that he felt like in a few years there'd be, when you went to the store to buy a new yogurt, on the side of the yogurt container would be how many carbon units were used to produce the plastic, how many people are being employed by the dairy that provided the yogurt itself, what kind of investments are being made by that company. And so there would be some kind of indication of the social impact of that product as you pick it up off the shelf to buy it. And that ultimately will direct the market toward more of an ESG focus, to where it's just a part of our normal lexicon as we're speaking to one another, and as we're purchasing products in real time. We're recognizing, okay, well, we're helping the environment by buying this product, perhaps not as much by buying this product. Maybe we'll go with this one, even though it's a few dollars more. So that's where I'm kind of seeing the market going. We can.
I mean, regarding this, is actually interesting that you mentioned that, because I believe that one reason why we have this problem right now. I mean, we do have, at least where I'm from, we do have labeling and quite well established certificates that allow you to understand where your products come from, if they are biological in the production process, free of hormones and so on and so forth. But at the same time, you do have um, the other dimension where you have a lot of products which have simply a lower price, sometimes a much lower price, and that implies that people will not are not able to shift to these other products in some way. So I believe that this is also a topic where the governments and the regulator has to step in eventually and say, okay, we have to stop dumping prices on such products in order to make the sustainable alternatives more competitive in terms of their prices, right? Because they are honest in their prices, they can't go lower, otherwise they will not be able to offer these sustainable alternatives. But the other the cheap alternative that does not focus on sustainability, they are basically trying to produce
Yeah,
as cheaply
way
as
to bring
possible.
that macroeconomic discussion down to a micro level, right?
Yeah.
No, that's great. So you said multiple times in this conversation so far, where I live, and so it's completely different over here. We don't have the level of regulation that you do. We are not focused as much on ESG as the European Union or even Europe as a whole has done. Our investors are waking to this. I believe that the money is coming to the conclusion that this is good for the world. This is good for everybody. And as more and more capital gets allocated to ESG focused companies, I think that more companies will begin to focus more on this so that they can reap that capital. Ultimately, we're seeing some of the bad boys getting kicked out of the larger funds, and it's hurting them. I mean, so this is going to get worse for those companies. I guess the point I was trying to make is that the U.S. is a bit behind Europe, always has been in regards to social impact
Well,
or
it
even
is
environmental
actually.
sustainability.
Mhm. There is actually you can actually see that when you look at the development of ESG scores of companies, over the last 10 years. You can see at when we started, Europe was already quite well. We had most companies, or there were quite a lot of companies that had high ESG scores compared to the amount of companies that had low scores. That was not the same in the US back then, right? So back then you had there was a uniform distribution.
Sure,
However, you can see over the last 10 years, the US have caught up quite a bit and
agreed.
show similar development in terms of the distribution of the ESG score landscape as Europe. So I wouldn't say that the US is so much behind on this. I think there are just maybe other forces driving this development, more market driven, because the big driving force behind this movement are the individuals, the investors, and the regulator is just then stepping in and trying to make this process and reflect what the market wants in some way. And that's where I think
So
Europe is a little
that's a great
further.
observation, Karl. That's a great observation. The observation is that at this stage of where we are in the ESG arc, the investors are driving the market. Whereas later on, I think the consumers are also going to drive the market. So right now, the consumers don't really have much of an opportunity to drive the market because there's not enough data. And as we discussed earlier, it's a possibility that data will be on the very products themselves, so that the consumer would have more control or more decision making in that arc. But right now, we're at where we're at. Uh, I'd like to switch gears if you don't mind, and let's talk a little about what you're doing personally. You mentioned that you were a part of a startup. I'd love for you to give us a little bit about that. Uh, what are you passionate about right now in your business life? What are you putting your time and energy into?
Mhm. Yeah, sure. So apart from my university job, I'm also a co-founder of a fintech startup in Austria. It's called Fincredible, and
Great
we are
name.
actually yeah, thank you. And we're actually developing digital credit check solutions. that is
Cool.
based. So in Europe we have the so-called Open Banking Initiative, which is a regulation or more a directive that basically changes the paradigm on banking data. So basically, what this directive says that the owner of a bank account should be the owner of all the data that he generates at the bank and not the bank itself. And the
Wow.
owner should also have the power to say, what does he want to do with that data? Does he want to make this data accessible for third-party companies that provide a service for him?
So that's a true DeFi company.
We're basically a so-called, in Germany, in Austria, there are lots of these companies. We're like FICO in the US a little bit. So that means we look at the credit risk of business transactions, and we then compared to in the past, we are now able to do this much more accurately by using this banking data.
Right, but you're
But
turning over ownership of that data to the consumer.
the consumer holds always the ownership of his data, but he just gives you temporary access to the data so that you are able to check his credit rating, his credit score, so that he can conduct transaction based on this information, because the transaction requires to know his credit rating, for example.
I mean, ultimately, what FICO does is they sell data that does not really belong to them. It belongs to the consumers technically, but they sell that
Yes.
data to banks and, to other credit reporting agencies or credit agencies to, to make a profit. The consumer never sees a dime of that. And ultimately, the consumer has very little control over the data that's in that system. So your company would actually do quite the opposite, putting more control over that data. Now, obviously, they can't put I make $1 million a year in there, if they're just a regular factory worker or something. But they can ultimately, I'm sure they can dispute transactions a lot easier, or dispute irregularities in their report a lot easier if they own the data, rather than
Right.
having this outside agency that controls everything, monolithic, if you will. And you're trying to write to the monolith to ask them, hey, listen, this report that this credit card company said I missed a payment or whatever, that's not true. I have the evidence right here. And it might take you 6 months to get that off your credit report here in the US with FICO, but when you're dealing over there, I'm sure it's a little easier to work with.
Well, it's. I mean, this is a general issue with this type of credit risk measuring. If you're based on historical data, which basically never get deleted, that implies that something that happened 10 years ago will affect your life also still today. That one can discuss whether this is good or bad, right?
Yeah, sure.
But what we do is we don't even rely on such type of technology. We are able to always access, after authorization of that consumer, always access the latest, the recent data. We use it for our credit analysis, and then we throw it away again, because we can always get access again in the future. We don't have to keep any of that data.
That's
So
smart.
that makes this a very different approach, more consumer friendly, in my opinion, and also more transparent, because the consumer always knows, first of all, when a credit check is being conducted about the person, which is not the same in the
Agreed.
in the other paradigm. And he always knows what data is being used about him. And
Gotcha.
he can, as you mentioned, dispute it, because he also understands and receives the result of that credit check. So that makes
product.
it a very different, and I would call it, kind of a little bit more sustainable way of doing business, because it ultimately what happens, it allows also for more sustainable lending and borrowing decisions. If you're handing out a loan to consumer based on a false credit information because the data is old, outdated, and whatsoever, then there's a high risk that loan will not hold very long, right? So this is something that we hope to help consumers to get these transactions done where they are maybe now wrongly prevented from doing, and on the other hand, make sure that these transactions then also hold, because the data is more reliable on it.
Sure. Okay, so that's your personal project. So from
Exactly.
there, let's go on to probably back a little to its sustainable finance discussion, but I'd like to talk to you about funds, and where do you see funds driving the market to, and talk a little bit about how you'd like to see that develop.
Right. So that brings me a little bit to the sustainable finance disclosure regulation that I can see in Europe, which I believe is a great example of how it can be done. We basically have a classification of funds now according to their sustainability, but there's also a lot of criticism on this disclosure
Yeah.
regulation because
I've heard
yeah,
everybody
first
say it's a good start, but
it's a good
nobody's
start.
saying
It's a
it's
first
perfect.
attempt, but yeah, it will hopefully become better over time. So that's the first point, and I can see many funds using ESG criteria to let their funds being classified into this new regulation. So that's a great thing that we can use ESG in order to be compliant with this regulation. But I believe that ESG has much more potentially over the long run, not only being used as a screening tool as it is being used at the moment, that you say, okay, funds don't include assets with a certain lower threshold score. That is
Right.
a very crude thing to do, and I think always leaves something missing on the table for the actual socially responsible investor. I think it can be more deeply integrated into the portfolio creation and portfolio construction of the
Yeah, that's
fund.
cutting with a
Um,
butcher knife as opposed to a surgical knife.
In some way, yeah. So I think where I would like to see this going is that in the future, companies that are truly ahead of the market, receive also more share of funds allocation in the future as compared to lower scores. Because now you only use it for screening, and then you allocate the assets according to some other algorithm, which is probably not in line anymore with the social responsibility idea.
Which is how
And
you end up with those companies that don't necessarily belong there, but they kick off great dividends, and we
yeah,
want our
exactly.
fund to be profitable.
Yeah, so there have always been SRI funds, which are basically exactly the same as conventional funds in terms of their financial performance, but also in
Right.
terms of their social responsibility. So one would argue that why is one an SRI fund and the other one not, right? So it's basically just in their official way how they create that fund. If they can claim to use ESG criteria to create that fund, then they can already be classified as an ESG, as an SRI fund. And I think that should change in the future, that ESG can be used in more direct way to basically award companies that are really doing great on in terms of their social
Yes.
responsibility engagement as compared to all the other firms.
Got
Because
it.
I believe that even if a company that has no ESG score at a certain point in time, if it gets rated, it will maybe not get such a bad score after all, if it's not one of these, let's say, troublesome industries.
Or
But
massive
that doesn't,
polluter or something, right? Yeah, I
yeah,
get it.
exactly. But that doesn't mean that this company actually has to change anything as well. And that's where I think the debate is also going at the moment. Does ESG actually provide positive impact? And that is, I think,
Yeah,
one
typically
argument.
the pendulum of the market typically goes in the wrong direction first and then makes a correction. Just my opinion. So I think we'll probably go too far first and then have to pull it back a bit, or maybe who knows? Maybe this isn't far enough. I don't know. Um, I'd like to wind things up
Sure.
with just a conceptual question. So it's my opinion that movements like this, they've got a beginning, they've got a middle, and then they've got an end. And I'm not going to say end in that people will stop caring about it. I'll just say that it begins to become just everything. Uh, there's a line from the Incredibles movie, Disney movie, where the villain says, "I'm going to give everybody superpowers, and when everybody's super, nobody will be." And so I feel like the ES&G market's ultimate end will be when everyone is focused on these things in regards to their business, in regards to what kind of impact it's having on both the community, smaller community, and the global community at large, what kind of impact it's having on the environment, and again, both local and global, and then ultimately how it's being governed, whether or not all parties, I'm going to say, are represented on their board, whether or not they're actually concerned with issues that may affect, certain populations and whether that population is represented on their board. So I feel like at the end, all this will wind up where everyone is already concerned with these things, and it'll no longer have to be a movement. It'll just be a part of our daily lexicon, as I said earlier. I'd love to get your thoughts on that before we close.
Well, I completely agree, and I think I have a good term for this. A movement stops becoming a movement when it becomes mainstream, right? And I believe that this is hopefully where we're going with this.
Excellent. Was there anything else that you'd like to share with us before we close out?
No, I think we were able to touch on a lot of topics. So thank you very much for inviting me once again.
Honestly, Karl, I'm so grateful that you took the meeting. Your qualifications are second to none. You've spent a long time doing research and trying to participate in this community. I feel like I've barely scratched the surface of what I'm doing. So I was so grateful to have this conversation. I don't want to gush all over you, but I'm really grateful that we had a chance to talk.
Thank you. I don't think you do that. You seem quite deeply involved already. So
I'm trying, but I'm trying.
Yeah.
Okay, so that was the Social Impact Revolution for today. We're grateful that you all watched, and you can reach Karl at the link that we just placed a few moments. There it is, right there. You can see what Karl's been up to there, and you can see us on our website, socialimpactinvestment.io. Hope to see you guys all the next episode. Bye-bye now.